One has seen uh, the Indian equity markets in the midst of a sharp correction. I think there are both global as well as domestic factors which are responsible for the tumult that we are seeing in India. And the Indian markets are no exception. I think all the emerging markets, since the election of Trump as the American president, have been witnessing a sharp fall. Uh, I think what one clearly is seeing is on a globally is that there is a massive asset churn or reallocation that is happening, in which money is moving out of emerging markets into developed markets. As a result of which, one is seeing that the emerging market currencies are coming down, the bond prices are coming down in emerging markets, that is, the bond yields are going up, and the emerging market equities also are coming down. Conversely, one is seeing that the US dollar is strengthening, US bond yields are going up, because the expectation is that with the very large public investment program announced by Trump of something like $550 billion of investment in infrastructure assets like roads, power networks, railways, the inflation will come back in the US. And the perception is that the US Fed has been too dovish in not raising rates. And a time will come where they will have to start raising rates abruptly and at a very fast clip. And hence the US bond yields have gone up. Similarly, US equities also have done well because of expectation of a reflationary trade. These large investments in infrastructure as well as lower taxation promised by Trump, both on individuals as well as corporates, and a one-time tax holiday is expected to lead to large inflows of money into the US from US corporates who have kept trillions of dollars in their subsidiaries outside the US. Now, all this sort of, how does it impact India? As I mentioned that today, I think all the investors have indiscriminately sold equities among all emerging markets. But once semblance of sanity returns and the dust settles down, then I think people will start looking at those emerging markets which are not going to be impacted as much as some others due to this shift out of emerging markets into developed markets like America. If you look at India, 70% of India's total GDP comprises of domestic consumption, and only 15% is comprising of net exports minus imports. Whereas if you look at emerging markets in the Far East, starting from Japan, South Korea, Taiwan, Hong Kong, Singapore, almost 60 to 70% of their total GDP comprises of net exports. And hence, any slowdown in global trade, any increase in protectionism that Trump engenders is going to impact global trade, and hence these economies which are dependent on for a large part of their GDP on net exports. So once this realization dawns on investors, they'll start looking at India, because India has, as I said, 70% of its total GDP coming from domestic consumption, young demographics, increased levels of affluence and aspirations, more digitalization happening. So as a result, I think investors will start looking also at the macro fundamentals. And India has never been in a better position insofar as macro fundamentals are concerned. If you look at some of the four key issues that investors look at with the medium-term investment horizon, they look at the growth in an economy. India will emerge as the fastest growing economy among large economies. India will have, the government is committed to medium-term fiscal consolidation plan. Thirdly, we have record forex reserves, and our current account deficit, which was our Achilles heel. If you remember, in August 2013, when the rupee had plunged, we have completely transformed our current account, and today we might end up in a situation where the current account will be minuscule or could even sort of tilt into a surplus range. And lastly, the inflation, I think, which was in double digits, consumer inflation has been trending down, and today it has it's lower than, it's around 4.25%. So from macroeconomic fundamentals perspective, India is in a very strong position and will continue, that's why, in my opinion, to attract large amounts of both FII flows and FDI flows over the medium term. The second issue, other than the global factors, is the demonetization. And there's a lot of noise about how would demonetization impact the medium-term growth impulses in the country. If you look at the surprise announcement of demonetization, I think it did take the markets by surprise because what the market was expecting is that after 2 years of drought, we've had near normal monsoons. Rural economy still constitutes a large chunk of the total domestic consumption. And the expectation was that post harvest in October, November, the December quarter will start seeing a massive bump up in aggregate demand from the rural economy. Also, the 7th pay commission payments that the government had created in the accounts of central government employees, as well as the OROP payments for defense personnel, also were expected to act as a booster for demand, especially in the consumption side. So that's why, after having seen tepid growth in profitability over the last few years, the market was expecting that the second half of this financial year, starting from the December quarter, we'll start seeing a turnaround in terms of the earnings growth. Now, what demonetization does is it essentially delays the improvement in the aggregate demand, in my opinion, at least by a quarter. So the earliest that one can now expect an improvement in consumption to happen is by March quarter. Why is that so? I think because in the wake of demonetization, there are certain adjustments that are warranted due to the shocks to the supply chains that all the companies have had. And there's also necessity to incorporate certain tweaks in the mode of conducting business. So these two issues, we believe, will push back the improvement in aggregate demand on the consumption side, at least till the March quarter. And the markets, that's why, have readjusted this shifting of demand by at least a quarter. The tremendous benefits that will accrue to the Indian economy from demonetization, I think, will be evident in the medium to long term. It is expected, now it's anyone's guess, that how much of the high value currency notes are not tendered back to the banking system. Now, the estimates vary from 10% to 40%. Total 14.5 lakh crores of high value notes are in circulation. Even if one assumes that 20% of those notes don't come back, roughly 2.8 lakh crores of currency will not be tendered back. And this will be, in a sense, extinguishment of liability of the RBI. Now, on the accounting treatment, there is still there's no consensus. But our opinion is that the government is very clear that this is transfer of unaccounted wealth from private sector into the government and public sector. So over time, in our opinion, this money should come back to the government as dividends, which the government can use, to reduce its for fiscal consolidation, to reduce its debt. But a large chunk, in our opinion, will be used by the government to pump prime the economy, to increase allocations to both social as well as physical infrastructure, increase in the road network, increase in power transmission network, improvement in the railway network, as well as also focusing on housing for all, or schemes like improvement in rural roads, sanitation, drinking water. So I think, a whole host of public works will get a boost, I think, from this massive demonetization program, which is quite historic in nature, that the government has announced. So although there are certain short-term hiccups, but I still feel that this is extremely positive from the medium-term perspective. The banking sector is a clear beneficiary of the surge in deposits. We already have seen 6 lakh crores of deposits coming into the banking system. The system is flush with liquidity. It will put pressure on the interest rates. We already have seen 10-year bond yields coming down. Banks also reducing deposit rates, and it will be also pressure due to the on the lending rates. We also will see that the incremental cost of funds of banks will come down, and the bond portfolio that the banks have will benefit. So there will be benefits on both the asset, on the bond side, investment portfolio, as well as the CASA accretion happening, and hence the cost of funds coming down. So banks, in our opinion, will be better positioned as compared to the NBFCs, which had seen a very sharp surge in valuations, and especially those NBFCs that deal mainly in cash for disbursals as well as for repayments will be placed in a slightly tougher position. So our preference will continue to remain with the banking sector vis-a-vis NBFC sector. Consumption-focused sectors, especially discretionary consumption-focused sectors, will, in our opinion, see some pushback in terms of improvement in demand. So sectors like automobiles, consumer durables, consumer finance, paints, home improvement companies, wherever where high value items sort of will basically see a pushback in demand. However, consumer staples will not see too much of destruction in demand, and especially the essential goods. I think the demand will continue to chug along at a good clip. Sectors like pharmaceuticals and IT will be completely immune from the demonetization change. We believe that in last 12 to 15 months, a lot of portfolios were focused on consumption, on consumer-focused sectors, and they were underweight on sectors like pharmaceuticals and IT. In pharmaceuticals in particular, we feel that a large amount of inflows could happen because it was expected globally. I think it was expected that if Hillary Clinton were to come to power, then she had adopted a very tough stance on the alleged increase in prices by the pharma companies. But now that Trump has come to power, who's more of a free marketer, I think that negativity has vanished. And the US FDA also has been expediting its approval of newer drugs, as well as some of the facilities that have come under cloud. I think the remediation measures that companies have done, I think one should start seeing over the next 12 to 15 months, more and more plants coming back into action. So I think pharmaceuticals will be a big beneficiary of this shift in allocation of money. In case of IT, I think although banking and financial services and manufacturing in America are expected to do well, and these are the two largest contributors to Indian IT outsourcing companies, the problem is that Trump's hard stance on having a close relook at the H-1B visa will be an overhang. One will have to see how the policy pans out in terms of skilled immigration and H-1B visa in particular. That's why I think there's a view on IT will be still cautious. I think it is in these times of uncertainty and asset price dislocation that when one looks back, one will say that I should have taken advantage of this short-term tumult in the market. And hence we urge investors that they should start looking at Indian equities because if you take a medium-term perspective, this is a great entry point for Indian equities. As I mentioned, the macroeconomic fundamentals of India are among the best ever and among the best as compared to other emerging markets. We are relatively immune from rise in protectionism and increase in trade barriers that the US might pursue during Trump's tenure because of domestic and inward focused economy that we have. And the advantages of demonetization will be evident in our view in the medium term. The markets in terms of valuations also are attractive if you take a 1 to 2 year perspective, and one can expect to as long as one buys good franchises which have sustainable competitive advantages and construct a portfolio around such franchises, this is, in my opinion, one of the best times to get into equities. Thank you very much. And if there are any queries, we would request you to get in touch with my colleague Nupur Patel or me at PLindia.com, Ajay Bodke @PLindia.com, or Nupur Patel @PLindia.com. Thank you very much.